I got a good one for you today. I promise you, you're going to learn something. I'm going to help you pin down the level of volatility and risk versus reward in your income portfolio and help you decide what you're comfortable with to have in your income portfolio and what you might want to put in growth. Now, I'm also going to go over my personal preferences, but hey, this is your money, your portfolio. This is completely up to you. And as you may know, my portfolio is a hybrid that contains growth also, not just income and cash flow ETFs. So keep that in mind. Now, some people do like to have an all-in 100% income generating portfolio. And although this may not apply as much to you, I think it still does apply. Maybe it could relate to the weightings in the various ETFs and the various holdings inside your portfolio. So here you can see I've taken these different holdings, ETFs, and I've moved them and I placed them from left to right, starting with lower risk or more diverse on the left, and then going towards potential higher returns and something more consolidated. Now you may land somewhere in the middle with your preferences, and you may decide, I don't like to see my BTCI drop 20-30%. My cash flow is coming out of there and I rely on that. And I definitely understand that. Some people, they don't want to see volatility in their income ETFs, and strategy is far more volatile. So some investments, when they are in the income ETFs, or they're the underlying in the income ETFs, you can see potential drops of 50, 60, 70%, wild swings in distributions, large cuts in distributions when you have reverse splits, and extreme capped upside potential, which also may be something that you want to avoid. So if you go down this list, I'm going to help you, decide where you may want to put all of your income and just cash flow out of these very specific ETFs. And then you can put the rest in growth or just weight them smaller than the others. And so you don't have to see those, the wild swings in distributions and your brokerage account balance. All right, so let's start here. Global Emerging Markets ETF. Now, I've been in emerging markets and global ETFs before. Some of them are quite popular, and it sounds good on paper. However, it exposes investors to currency exchange risks. You can see here, investing in global or emerging market ETFs introduces currency exchange risk where fluctuations in foreign currencies against the investor's home currency, maybe it's USD, can enhance or erode returns. And then it goes on to say a strengthening USD can hurt the foreign investment returns. It could work the opposite way too, but you're really exposing yourself to unnecessary risk. This is not necessary, and U.S. brands, particularly the large cap U.S. companies, they are global companies. So, for example, if you've traveled to, say, Asia or the UK, you've seen Boots, and you might think, oh, well, that looks familiar. Yeah, because that is the same brand as Walgreens in the US. Pepsi, Coke, they're all global brands. If you want a global brand, you really don't need to be in these global ETFs, these emerging markets. You're just taking on more risk. So I would say, just get rid of that. It's not necessary. Just go into US-based companies. S&P 500 is next. Now, I think this is the first viable option. However, this is going to be the most controversial topic that I discuss, I'm sure. When you invest in a broad market index like the S&P, you gain exposure to hundreds of companies, 500 companies. That is not necessary. And it could actually be harmful because of diminishing returns when it comes to diversifying what you're invested in. Diminishing returns in stock diversification occur when adding more stocks fails to significantly reduce portfolio risk while simultaneously reducing potential returns, known as diworsification. Benefits diminish rapidly after 10 to 30 stocks, with 12 to 18 often providing 90% of maximum diversification benefit. 30 stocks, it's nowhere near 500. It's not necessary. I think I read this number, and I'm going by memory here, but I believe it was around 60 is where it really falls off a cliff. And there's pretty much no benefit past 60 different holdings or securities where you just no longer benefit from it. So you don't need exposure to 500 companies. It's unnecessary. And a lot of people think, well, this makes it safer, when in reality what you're doing is you're really diluting your portfolio. Most of the holdings in the major indexes, they're going to have a negative performance over their lifetime. Now this puts the estimate around 51.6 to 58.6% of publicly traded companies. And you might think, well, how does it have a negative lifetime return? Well, it may IPO, around $10. If it goes to zero or it gets delisted, that is a negative return. And that's shocking. It's over half. When you're going into these large indexes, some of your money is being funneled into these companies. They're dying, they're on their way out, they're about to get kicked out of the index. It happens every year. And really, most of them are just being carried by a handful of stocks. And it goes on to say most of the wealth is generated by a small percentage of top performers. A study on data from 1925 to 2023 found that 51.6% of equities had a negative lifetime return. Another study shows a slightly higher 58.6% delivered negative cumulative returns over a century. And this researcher indicates that while a majority of stocks failed to outperform treasury bills, a very small percentage of outliers created the vast majority of market wealth. It was 17 stocks. And now a more modern study and analysis starting in 1983, it got a little better, but it found that 39% of stocks had negative lifetime returns. So this is something to think about. And I know, people say that, well, if you try to be an active trader, you try to pick stocks and, you don't go into the indexes, it's just not going to work for most people. But however, those numbers are skewed, and they have what's called the rule of 90. In active trading circles, a rule of 90 often refers to a different concept. 90% of new traders lose 90% of their money in the first 90 days. Yeah, so these are novices, and they do terrible, and they skew the numbers. And guess what happens if you lose 90% of your money in a very short time? You're probably going to run back to the indexes and say, I'm not going to try that again. So, but the people that stick with it and actually educate themselves on how to invest, how to evaluate a company, they're going to fare much better. And you also have probably heard that professional traders seldom beat the market also. Well, I would argue that they go after fees first, and they go for these oversized returns that are overly complicated. There's also a term that's called career risk, where these professional traders focus on reducing risk rather than maximizing returns because they don't want to lose clients. It's all about their career. It's all about money. And it often results in closet indexing. So now they're performing similar to the market, but they have high fees. And those high fees are what makes it so their clients don't actually outperform the market. So there's an element of human greed behind that statistic also. And this is kind of getting into conspiracy theory territory, but Billionaires, they need a working class. They want a service industry. Billionaires are not in the business of making more billionaires. Also, going back to this flow chart, you'll notice an index that isn't there is the Russell 2000. You don't need exposure to 500 companies. You sure as hell don't need exposure to 2,500 companies. It's like, no, stop. Small cap, it underperforms, period. And you need capital appreciation when you cash flow with these ETFs. Forget about the Russell. I think the next one, the NASDAQ 100, is a better bet than the S&P. Now, yeah, you have a lot of diversification. You have 100 holdings. But I think if you were to go with the major indexes, I would choose the NASDAQ 100. Why? It's heavier than the S&P in AI and other big tech. Now, some people will say that it's too tech-centric, but there are several consumer staple holdings in the index. So here you can see a list of the consumer staple stocks that are in the NASDAQ. We have Costco, Pepsi, KDP, Monster, Kraft Heinz, and there's Walgreens Boots. And having these major retailers and these global brands inside the NASDAQ can help you, it helps stabilize it. But at the same time, you have a really good chance at overperformance because of the heavy tech presence that's in the NASDAQ. Also, there's fewer holdings, so you could have larger weightings in some of those holdings. Now, this is the dividing line where I see things getting very interesting. And this is where I think a lot of people should really consider, to take their portfolio, to take their total returns to the next level and their possible distributions to the next level. This is where they should consider cash flowing, because I think it could be life-changing, to be honest. The MAG7. So cash flowing with a MAG7, you can also add in growth positions to get to those 25, 30 positions that we were talking about earlier to, more maximize your diversification and lower your risk. But when it comes to the MAG7, you have the hyperscalers, AI, you have very diverse companies. These companies, some of them, like, think about Amazon, Google. It's a conglomerate. Google may be a pharmaceutical company in the future. You're going to go into possibly different sectors because of the use of artificial intelligence. Don't really look at it as being in 7 positions if, say, one was just utility and one was an automaker and one was a retail giant, right? These are actually diversified companies. That's another added benefit to it. Now, when it comes to cash flowing off the MAG7, there's a couple of options, and I want to go over those. Now, when you look at the overall return, you could see YMAG is double in total returns. However, we do have a problem, because when you look at the charts, okay, when you see something like this, negative 36%, known as NAV erosion, this is really tax inefficient. And the more money that you have in this, the worse it is for you. In other words, if you're in a higher tax bracket, this is just going to be worse for you. So this isn't an option for everybody, unfortunately. You want to avoid tax drag, and you want to avoid being double taxed on your money. And when you see a chart like this, that tells you that's exactly what's going to happen. Now, Maggie is slightly better. And look at their chart. It's a little more stable. Okay, but I have an alternative that I want you to consider, but it's not out yet. However, I looked at the Edgar, the SEC filing the other day, and this is from Tap Alpha. Okay, so, and this is actually a MAG10 that they have filed with the SEC. Once they file, it typically takes 3 to 6 months. It depends on, a few factors like regulatory hurdles before they're approved. So look for this in the coming months. It is not on the market now, but the ticker will be TMGN. I have the Edgar right here, but don't worry, you don't have to read it. I'm going to give you the cliff notes because I read through it. So this is an equal weight 0 DTE fund. Okay, so you may not actually like the idea of equal weighting. Do you want Apple to be an equal weighting to, say, Nvidia? Maybe you don't. Maybe you would like this more weighted with market cap. So that's something to think about. 0 DTE. So as you know, this has worked with other funds where they get exposure in after hours to the European market and the Asian market, and so you have less capped upside while also collecting premium. And they'll trade 0 to 10% out of the money, and it's a pretty complicated set of tools that they use. They can use puts and spreads. And I really appreciate seeing that, because that tells me that the fund managers are interested in high performance. And when you look at some of the other funds, let's look at TDAC and its performance to some competitors. Okay, so this is Tap Alpha. You'll see them on the bottom. Well, their total return has done really well when compared to Neos and Roundhill. So this looks really promising if they can pull this off and hopefully stabilize that NAV. By the way, the other holdings that would be added to the MAG7 would be AMD, Broadcom, Palantir. Great additions. I think it could be possibly a very good way to cash flow, and then you put your Bitcoin, your Ethereum, maybe a smaller cap into growth, and you won't see the huge pullbacks in your income ETFs, because you don't want to see that necessarily, right? So this could be a good option, but we're gonna have to wait a few months for that, and I wish I had a date, but I don't. Oh, and real quick, I wanted to show TDAC in their chart, and you can see it's actually up 4.56%. So hopefully the MAG10 ETF can do the same when that's released. That would be great to cash flow with this. Higher returns than the major indexes, hopefully a stable NAV. And then after the Magnificent Seven, I put sector ETFs in the next phase over, and multiple, because I don't think you want to be in just one sector. Although if you were to be, if you were to cash flow in one sector, I would pick semiconductors. So there's several that come to mind. For example, Chippy, you could cash flow with semiconductors. You have the FANG index. You have AI, space, energy. There may be some better options in the future for sector ETFs. If you have any ideas, drop a comment below and let me know. But those are just some that off the top of my head that I think can do really well. Very high alpha stocks, high returns, beating the market, larger distributions, and then putting more volatile holdings and assets into growth, or just scaling them back a little bit. And at the bottom you'll see here, no fund of funds. Yeah, they fund of funds, they're just a cornucopia of failure and depression. I don't know, they just don't work. I think it's just random stocks that have been put in there, and there's just some stinkers in there every time, and it just brings everything down. So I have avoided the fund of funds. Now, if you know of one, let me know. I'm trying to think of a fund of funds that is, seems reliable, but I can't think of any. And then my preference, individual companies or assets. So, this could be things that are highly volatile, like strategy. So why would you, cash flow with individual companies and assets? Well, it's pretty simple. Greater total returns. That's what I'm going for. Larger distributions, larger returns over time, especially if you can capture that upside more. The cons, wild swings in your net worth, right? So Your brokerage balance is part of your net worth. Maybe it's the majority of it if you're retired. You may not like seeing those wild swings in your brokerage account. Volatility in payouts, they could vary greatly from month to month, even week to week. And also a time sink, because you have to do a lot of research and education when it comes to investing in individual companies and individual assets. But the reason I choose it again is for the potential for larger total returns. So that's it. Something to think about. Like, don't try to go into all of these. It kind of defeats the purpose. The purpose is to figure out how you want to cash flow and put your income money there, your income portfolio there, and then the other more volatile things that you can't quite stomach into growth, or you could limit your exposure to it. Thanks for watching. Remember to like, subscribe, comment, and I'll see you in the next video. Stay tuned.